Thank you for the kind introduction. My name is Matre Ellingsen. I'm the CEO of Fearnley Securities. I just have a couple of slides I'd like to present for you today before the really kicks off with other companies. First of all, I hope someone can recall that last year we are fairly bullish on the shipping industry in general, and specifically we point out that from our point of view, we saw that bulkers' second-hand value was too depressed. In the meantime, from the left-hand side of the graph, you can see that we have had a 37% increase in second-hand values, which we think is extremely positive. For those of you who interacted with us at that time, or either buying ships or equities, have had a very nice run. We still see a very healthy order book, so we are still extremely positive to the bulker segment. What we have seen during 2017 and really also 16 is that the capacity from big banks towards the capacity to lend out for shipping loans has been significantly reduced. The article I'll show you here, the theme is from a Reuters article in July this year, stating one of the Citigroup head of global shipping estimate. He said that approximately $150 billion of shipping loan is underwater or non-performing. And if you combine this situation to the new regulation from Basel, we have seen and we have learned from our clients that the banks are not able to support the shipping industry as they were before. We are happy that there is alternatives. This is a kind of messy graph, but what you can see is that the bond activity has increased significantly, and we are certain that this year we will see a significant higher activity than last year. You can also see that the companies that are really using the bond market is the dry bulk companies, and last Friday we just closed a $100 million secure bond for a container company called MPC. So essentially what we see is that there is risk capital available for good companies with a decent risk profile. So a little bit marketing. It has been a very, very nice year. We have been happy, Fearnley Securities have been happy to work alongside very nice companies, and we have been invited to help them to raise capital. And the last 12 months we have raised approximately $2,100 million to very, very good names. As you can see, many of them are listed in the United States. No one in London so far. We hope there will be some. And of course, a good number on the Oslo Stock Exchange. A little bit more marketing. I won't use too much time on it, but we are extremely proud that we think that we have been active in more than 40% of the transaction in this space last year. And for a small company based in Norway, that is really an extremely high number. We are ready to do business with you, and we think the bond market and bond investors are really keen to invest. We met more than 100 investors last 14 days, and they're all keen to invest in shipping bonds. So a little bit about the contracting activity, and this is of course key. What I like to focus on is really the two figures on the right, bottom and up right, showing that in the bulker space, there still is a very, very nice situation in terms of new bidding. There's been very few orders, meaning that the balance really is improving even more than last year. We have seen that in activity and term rates, and we are extremely bullish still on that segment. The same goes with container shipping. Last year, end of last year, we saw that you could really buy 3 to 4, 5-year container ships for 25%, close to 30% of the replacement value, and that was extremely interesting. We see today a massive consolidation among small feeder companies, And some of the big players are also very, very positive towards container activity going forward. Energy need to be transported. What you see, the green figure here is really the oil volume, the oil production, and the global energy consumption based on various elements like oil, gas, and coal. There was a 1% increase in energy based on oil last year. It was a 1.7% increase in gas, and of course there was a significant downscale on coal. But still, this massive energy that needs to be transported on ships. We still see values on ship and asset far below fair values, meaning that there should be opportunity for both companies and investors in the shipping space. I would like to kind of draw your attention to 3 segments, which we are monitoring closely. If you would like to get exposure into shipping, you can either, of course, buy asset or you can buy equity or bonds in very, very nice companies. In the tanker space, we see really that the valuation, from our perspective, is independent. You're well off if you buy a ship, or you're even if you buy equity. So there's no big discount. That's the way we look at it in the tanker space. In the dry bulk space, there's very nice opportunities. As you can see from if you buy into Navios, and I would like to add Eagle Bulk is just above, would be approximately the same range as Navios. You can buy it with a dramatic discount to value. We think that is temporary. That will be, we think that during this year, we will see a massive increase in equity prices due to really the earnings and the valuation of the steel in the companies. And also to remind you a little bit, though, we are talking today about shipping, but we should not forget about an extremely important part of the bank's balance sheet, which is offshore, oil rigs and oil service activities. New building prices, 10 years average on semi-submersible was $800 million, and probably if you go to yard today, we have to pay $600 million. You can really buy, if you buy into Transocean, which is the largest drilling company in the world today, the implied value of that rig is just about $200 million. And can I give you a little bit historic backdrop? If you follow Transocean in 2002, the share price bottomed at $18 a share. A couple of weeks back in time, it was $8, and yesterday was 8.5. So for those of you who have some spare capacity, I would strongly advise you to have a look at the drilling companies in the US. They are extremely undervalued. We see massive increased activity just in new activities related to drilling. We have seen the bottom this year. We are certain about that. So, and one backdrop of that is the next slide, which we think is interesting. It's a little bit complicated to understand if you just flip into it. But what we present on the left-hand side is really what kind of cash flow did the oil companies have when the oil price were at $100 a barrel. It was negative because you have to take into consideration dividend. And you see, in 2013, the operating cash flow just kind of was equal to the capex. But then they also paid dividends, so there was a significant negative cash flow in the oil companies. On the right-hand side, you will see our estimate from 2017 and 18. These are based on the largest oil companies in the world. They have a positive cash flow after dividend. So they're now starting to invest in activity. Yeah, this I should not spend too much time on this one, perhaps, but talking about oil prices is extremely complicated. And we always said that it is impossible to have a good prediction. And to give you an example of that, as you probably well know, Norway has a lot of oil and we are absolutely dependent upon it. And every year we try to kind of focus in the national budget, what would the oil price be? And back in 2000, the Oil and Energy Department hired the best people in the world to predict the oil price. And they concluded after 1 year work, it was absolutely no chance to predict the oil price. So the best oil price prediction would be today's price. This table and figures based on EIA's numbers, and if they are right, well, they need to find 8.8 million barrels more oil unless we have a massive problem in the energy supply. So if that is correct, there will be significant activities in the oil service sector going forward. We strongly believe in that. Pre-salt in Brazil, cost break-even is probably just about 30, between 35-ish. We have seen cost break-even from the Norwegian large field being developed these days, coming from it's $85 to $40 and below. So offshore oil fields has a very nice cost profile, lifting cost. To sum it all up, my analyst team is working hard. They have a very good recommendation for many, many years. For the time being, we feel that there's some clear message we would like to give to the audience. First of all, we have bottom up in 3 sectors: containers, LNG carriers, and dry bulk. So we are very positive in that sector. There's plenty of capital to be invested, and we need some company to attract investors and investors are asking us to present to them companies that need capital. So I think that is my main message. We still think there is a little bit too early to be over-invested in product tanker, in crude and LPG. Thank you for your attention.